Australia experiences improved international competitiveness when there is A higher domestic inflation rate than its trading partners. This one is incorrect, as it would mean Australia's goods are more expensive relative to foreign goods, which would decrease Australia's international competitiveness. B, an appreciation of the Australian dollar. This one is also incorrect. As the value of the Australian dollar appreciates, this means foreign consumers have to pay a higher price for Australia's exports, thus decreasing Australia's international competitiveness. C, an improvement in labor productivity. This one is correct. As the level of Australia's labor productivity increases, this means domestic firms can increase their output without an increase in inputs, therefore decreasing the cost per unit of output for these domestic firms. Thus, they can charge a lower price on their exports, which will increase Australia's international competitiveness. D, higher domestic real wages growth than its trading partners. This one is also incorrect. If our real wages are higher than our trading partners, this would mean we are paying a higher cost of input. If our cost of input are higher than our trading partners, this would mean we would have to increase our price, therefore decreasing Australia's international competitiveness. Which of the following factors facilitate globalization? So globalization is just when countries become more dependent on each other. So 1, trade liberalization. Well, this one is correct, as this would increase trade. 2, improvement in transport and communication services. This one is also incorrect, as this would encourage foreign investment and trade. 3, growth and expansion of multinational corporations. This one is also correct. This would encourage foreign investment, the transfer of technology and knowledge, and increased trade. 4, increased tariff protection for domestic firms. This one is incorrect, as this would decrease the amount of trade between countries. So we have 1, 2, and 3. The answer D is correct. The following graphs represent the production possibilities for Germany and Italy and 2 products, cars and boats. According to the above graphs, which of the following statements is correct? So looking at the answers, we can see that this question is a comparative and absolute advantage question. So an absolute advantage is when a country can produce more of a certain good over another country. A comparative advantage is when a country can produce a good at a lower opportunity cost than another country. Looking at car production, Germany can produce 40,000 cars while Italy can only produce 20,000 cars. Therefore, Germany has an absolute advantage in car production. Looking at boat production, Germany can produce 40,000 boats while Italy can produce 25,000 boats. Therefore, Germany has an absolute advantage in boat production. Now, to find the comparative advantage, you would have to calculate the opportunity costs. So doing that, we get 40 divided by 40, which equals to 1. And then same thing over here, which equals to 1. And then for Italy, over here, it would be 20 divided by 25, which equals to 0.8. And then 25 divided by 20, which gives us 1.25. So if we look at the opportunity costs, you can see that Italy has the lowest opportunity cost in producing boats. Therefore, Italy has a comparative advantage in producing boats. And if Italy has a comparative advantage in producing one good, we give the other country the other comparative advantage. So Germany would have a comparative advantage in producing cars. Now let's go through the answers. A, Italy has a comparative advantage in producing boats. This is true, and answer A is correct. Which of the following statements regarding the composition and direction of Australia's trade is correct? So this is a 2022 paper, but let's go through the answers. A, Australia's largest two-way trading partner is the European Union, so this one is incorrect. It is China. B, there has been a recent shift in the direction of Australia's trade toward Asia over the last 10 years. This one is correct, and the reason is because Australia has increased their trading with China. C, Coal is Australia's largest export commodity. This one is incorrect. It's iron, and it usually is iron. D. Since 2020, tourism has been Australia's largest import category. This one is also incorrect. It's manufactured goods. Which of the following would be recorded as a credit in Australia's current account? A. A New Zealand citizen buys a holiday home in Perth. This one is incorrect, as this would be recorded as a credit in the capital and financial account. B. A New Zealand company invests in an Australian mine. This one is also incorrect, as this would be recorded as a credit underneath the capital and financial account. C. An Australian company sells wine to New Zealand. This one is correct. This would be recorded as a credit underneath the trade balance, which is recorded underneath the current account. D. An Australian mining company pays dividends to its New Zealand shareholders. This one is also incorrect, as this would be recorded as a debit underneath the primary income balance, which is underneath the current account. A financial account surplus would result in. So what is a financial account surplus? Well, it's when the amount of foreign investment into Australia exceeds the amount of investment Australia invests abroad. So that means Australia's foreign equity and loans are increasing relative to Australia's foreign assets, therefore increasing Australia's net foreign liabilities. So the correct answer is B. Now let's go through the other answers. A decrease in Australia's net foreign liabilities. This one is incorrect, as this would relate with a financial account deficit. C, an increase in Australia's holding of foreign assets. This one is also incorrect. A financial account surplus wouldn't necessarily increase Australia's foreign assets, as Australia could have just not invested more overseas or sold their foreign assets, therefore keeping foreign assets constant or decreasing it. D, a reduction in inward foreign investment into Australia. This one is also incorrect. A financial account surplus would result in a higher foreign investment into Australia. Since 2019, a main cyclical reason for Australia's current account outcome is, so what happened during 2019? Well, Australia recorded a current account surplus for the first time in 40 years. So let's go through the answers. A, high commodity prices. This one is correct, as this is a cyclical component. Furthermore, a high commodity price would lead to an increase in the trade balance, which contributed to Australia's current account surplus. B, a savings investment gap. This one is incorrect, as this is a structural component. And because Australia has a savings investment gap, this would mean we would have to rely on foreign investment to fund our investment needs. Therefore, we would have to pay interest and dividends overseas. This has led to a deficit in the income balance, therefore causing Australia's current account deficit for the past 40 years. C and D, they pretty much mean the same thing, as both of them would mean we would have to pay more interest and dividends overseas, therefore decreasing the income balance, thus contributing to Australia's current account deficit. So they're both incorrect. The top 4 currencies by weight in Australia's trade weighted index are, so this is a stat question, and you can often find these statistics in websites such as the DFAT or ABS. So I'll put that in the description. But in general, we always know that China is first. So this leaves us with answer A or C. Now going through it, in this case for 2022, the answer would be C. An Australian consumer imported a car from the United States and paid 40,000 Australian dollars. If the USD/AUD exchange rate was 1 USD for 1.43 AUD, the approximate price of this car in USD was, so to calculate this, it's simply 40,000 divided by 1.43, and that gives us a value of 27972, and then we would just round it, so the answer would be D. Australia's foreign debt represents mainly the extent to which A, foreign residents own Australian assets. This is incorrect. This would be considered foreign equity. B, Australia owns foreign assets. This is obviously also incorrect. This would be considered as foreign assets. C, Australia owes the rest of the world. This is true. D, Australian companies borrow from overseas. This is incorrect as it doesn't include the public sector, such as the government or households. Which of the following statements about Australia's foreign debt are correct? 1. High foreign debt levels can cause a downgrade in Australia's credit rating. This is true, as high foreign debt signals financial risk. This would lead to a decrease in foreign investor confidence, which may decrease the credit rating. 2. Government debt is the largest component of Australia's foreign debt. This is incorrect, as government debt is the same thing as public debt, and public debt makes up about 30% of Australia's foreign debt, and private debt makes up roughly about 70%. 3. A depreciation of the Australian dollar causes an increase in debt service costs. This is true, as loans that are denominated in foreign currencies, like the USD or yen, a depreciation of the Australian dollar would mean we would have to pay more on our interest repayments, therefore increasing our debt service costs. 4. High foreign debt can lead to higher per capita income in Australia. So the answer key says this is true or not true. It could be any. Now let's go through why it's not true. Well, if we have higher foreign debt, that would mean we would have to pay interest overseas to foreign investors, which would decrease our per capita income. Now let's go through why it could be true. Well, if we have high foreign debt, what can we use with that money? Well, we can use the loans to increase and invest into our capital infrastructure, which would increase labor productivity, leading to a higher per capita income. So let's go through the answers. A, this is incorrect. B, this could be correct. C, this is incorrect. D, this could also be correct. Which of the following factors are both characteristics of an economic recovery? A, relatively high levels of consumption and high domestic interest rates. So this one is correct. High domestic interest rates is incorrect. If domestic interest rates were high, this would likely decrease economic growth, which is not a characteristic of economic recovery. B, contractionary monetary policy and expansionary fiscal policy. Well, this one is incorrect, as this would decrease economic growth. Expansionary fiscal policy, this is correct. C, low levels of consumer confidence and high levels of cyclical unemployment. These are both incorrect, as this would cause a decrease in economic growth, which is not a characteristic of an economic recovery. D, increased capital investment and improving levels of business confidence. Both of these are correct, as during a recovery, business confidence would start rising, and therefore they will increase their capital investment. An example of a leading economic indicator signaling a recovery is A, an increase in new employment vacancies. This one is correct, as this is a leading indicator, and if the level of new employment vacancies increase, this means firms are demanding more labor and thus signaling a recovery or expansion. B, an increase in consumer debt. This one is incorrect, as this is not a leading indicator. C, maximum capacity utilization. This one is also incorrect, as this would signal that the economy is in a peak. D, high levels of inflation. This one is also incorrect, as this is a lagging indicator and not a leading indicator. Refer to the diagram below to complete question 15. Using the data above, the marginal propensity to save and the multiplier are approximately, so they gave us the consumption function diagram, and they gave us the level of disposable income and consumer spending. So by using this diagram, we can figure out the MPC. And why? Well, because what is the MPC? Well, the MPC is equal to the proportion of the increase in disposable income that is spent on goods and services. So to figure out the MPC, it's simply the increase in consumer spending divided by the increase in the level of disposable income. Let's do that. So there was an increase of 600 and an increase of 900. We could do 600 divided by 900. So our MPC would equal to 0.66. Now, this is our marginal propensity to consume. Now, to figure out the MPS, well, it's just MPS equals to 1 take away 0.66. So that gives us 0.33. And then, since we have the MPC and MPS, we can figure out the multiplier. So let's just use the full multiplier equation. 1 divided by 1 take away MPC. And as you can see, this is just the MPS as well. So you could have just done 0.33. This is the MPS as well. So that it would equal to 3. So we have the multiplier of 3 and an MPS of 0.33. So let's go through the answers. A, 0.66, wrong. B, 0.33, and 3, that is correct. In the Keynesian aggregate expenditure model, macroeconomic equilibrium occurs when A, the balance of payments sums to 0. So this is incorrect, as this could also occur during a expansionary or contractionary gap. B, government expenditure equals government revenue, same thing. This could also occur when the economy is in a contractionary or expansionary gap. C, inventory levels are constant. This is correct, as during macroeconomic equilibrium, demand is equal to supply, so therefore inventory levels are constant. D, aggregate demand exceeds aggregate supply. Well, this is incorrect, as this would mean the economy is in a expansionary gap. In relation to the aggregate demand / aggregate supply model, which of the following will shift the AD curve to the left? An increase in A, Australian exports to China. This one is incorrect. If exports increase, this would increase Australia's net exports and therefore increase aggregate demand, which will shift the AD curve to the right. B, an increase in the cash rate. This one is correct, as this would increase the cost of borrowing for households and firms. Therefore, they will take out less loans and therefore decrease consumption and investment. Furthermore, a higher cash rate could lead to appreciation of the Australian dollar, making Australia's exports less competitive and therefore decreasing net exports. With these factors, it would decrease aggregate demand, therefore shifting the curve to the left. C, business confidence. This one is incorrect. If business confidence increase, this would increase the amount of investment and therefore increase aggregate demand, which will shift the aggregate demand curve to the right. D, disposable income. This one is also incorrect. If disposable income increases, households will increase their consumption, therefore increasing aggregate demand, which will shift the curve to the right. If the Australian government's budget is currently in a deficit, which of the following could increase this deficit? 1, an increase in government infrastructure spending. This one is correct. If the government increases their spending while in a deficit, this would largen the deficit. 2, an increase in mining company profits. This one is incorrect. If companies or mining companies are earning more profit, this would mean the government would earn more corporation tax revenue and thus decreasing the deficit. 3, a decrease in taxation rates for middle income earners. This one is correct, as it would mean middle income earners have to pay less to the government, therefore the government will earn less taxation revenue, which would increase the deficit. 4, a decrease in the unemployment rate. This one is incorrect. If the unemployment rate decrease, this means more people are working. If more people are working, the government will earn a higher income tax revenue, and therefore fiscal policy has a long decision lag compared with monetary policy because A, economic indicators may be out of date when policymakers analyze data. This one is incorrect, as this is not a decision lag. B, government proposals must normally be agreed to by both houses of parliament. This is true, and this is a decision lag. C, decisions impact household spending and business behavior with a lag. This one is incorrect, as this would refer to a effect lag. D, budgetary decisions require approval from the Reserve Bank of Australia. This one is untrue and it's incorrect. Assume the Australian economy is experiencing the following economic conditions. Inflation 2%, economic growth 1.5%, unemployment 6.5%. On the basis of the data, the Reserve Bank of Australia would most likely. So what are the goals of the RBA? Well, it's a inflation rate of 2 to 3%, economic growth of 2 to 3%, and a unemployment rate, depending on the teacher, 4 or 4.5%. So let's go through the answers. A, leave the cash rate unchanged as price stability is its main objective. This one is incorrect. So although price stability is the RBA's main objective, they would still want to reach the 2 to 3% economic growth and a unemployment rate of 4 to 4.5%. So obviously the RBA would change their cash rate. B, increase the cash rate to reduce the level of aggregate demand. This one is also incorrect, as the RBA increases the cash rate, leading to a decrease in aggregate demand. That's going to decrease economic growth and unemployment even further. This is because the cost of borrowing for firms increase, so they're going to make less profit, and also they're going to decrease their output and hire less employees. C, sell government bonds to the public to increase liquidity in the financial sector. This one is also incorrect. If the RBA sold government bonds to the public, this would actually decrease liquidity in the financial sector. And the reason is because banks will exchange their money, which is liquidity, for government bonds. D, reduce the cash rate to increase the level of aggregate demand. This one is correct. If the RBA reduces the cash rate, leading to a higher level of aggregate demand, this will increase economic growth and decrease the unemployment rate, as firms have access to cheap money, allowing them to invest and hire more workers, therefore increasing economic growth and decreasing unemployment. The inflation rate will rise slightly, however, it will still be in between the 2 to 3% range, so the RBA would decrease their cash rate. A weakness of monetary policy compared with fiscal policy is that it A, tends to be relatively ineffective during a recession. This is true, as during a recession, consumer and investor confidence is really low. Therefore, even if the RBA decreased the cash rate to 0%, domestic consumers and investors would still be hesitant to take out loans, therefore only slightly increasing consumption and investment, hence making monetary policy ineffective during a recession. B, has a long implementation lag. This is incorrect. Monetary policy has a shorter implementation lag compared to fiscal policy. C, can have a powerful effect on the level of spending in the economy. This is incorrect. Fiscal policy has a greater effect on the level of spending in the economy, as it's more direct, and monetary policy is indirect, as it has to affect the level of spending through the transmission mechanism. D, is not effective in controlling high levels of inflation. This is untrue. Monetary policy is super effective in controlling high levels of inflation. Which of the following causes of structural change can be attributed directly to government policy? A, changes in consumer preferences. This is incorrect, as it's not a government policy. B, lower levels of tariff protection. This is a government policy and therefore it's correct. C, higher levels of GDP per capita. This is also incorrect. It is not a government policy. D, changes in mining technology. This is also incorrect. It is not a government policy. Multi-factor productivity best refers to the A, increase in human capital from migration. This is incorrect. B, growth in output produced using a given amount of input. This is correct, as it's the definition of multi-factor productivity. Which of the following outlines the difference between labor productivity and multi-factor productivity? A, multi-factor productivity is easier to measure than labor productivity. This is incorrect, as multi-factor productivity measures a various amount of inputs, while labor productivity only measures the amount of output per hour worked. B, new capital equipment will only increase multi-factor productivity. This is also incorrect. This would also increase labor productivity. C, labor productivity is more closely related to workers' wages than multi-factor productivity. This is correct, and it's true. D, only multi-factor productivity improves with technology. This is also incorrect. Labor productivity would also improve. Question 25A1. Identify a form of protection referred to in the article. So reading the article, they talk about a quota and tariff right here. So for my answer, I'm just going to write tariffs. Now part 2, with reference to the article, identify the proportion of Australia's agricultural exports that were exported to its FTA partners in 2020 to 2021. And it states it right here, 3/4. So you would just write 3/4 in words. Question 25B. Describe 2 ways in which organizations such as the World Trade Organization can influence world trade. So this topic has been removed out of the syllabus since 2024. So it's not worth studying at all. But I'll show you guys a sample answer. So here, I just describe what the World Organization does, and pretty much I give examples and just explain what they do, right? So World Trade Organization sets rules for free trade agreements, and then I give an example of a rule, explain that rule. Then over here for 2, also did the same thing. And again, this topic was removed out of the syllabus, so there's no point of studying it. Now let's go on to the next question. Part C, using an appropriate model, illustrate and explain the effects of a subsidy on domestic production, imports, and market efficiency for 6 marks. So we know our model is going to be 2 marks, and that gives us 4 marks for our explanation. So it's safe to say there's going to be 1 mark for market efficiency, 1 mark for imports, and 1 mark for domestic production. And we have that extra mark somewhere. Now that extra mark could be anywhere. It could be including enough detail in your explanation, or maybe using the model within your explanation, right? But it doesn't matter because we're going to be doing both of those. So let's do the planning. Our model is going to be a simple, generic subsidy graph. Now for explanation, let's start. So it's good practice to define the thing that you're talking about. So they have us talking about a subsidy. So I'm going to define a subsidy. Now you're not going to get like a mark for it specifically, but it'll make your work much better. Define a subsidy. What is a subsidy? It's a grant from the government given to domestic producers, which lowers their cost of inputs with the goal of increasing domestic production. Right, so that's our simple definition of a subsidy. Now, after defining a subsidy, you could just go into explaining. But another thing that you should do, and it's good practice, is to give an example. And the reason why you should give an example is it's going to make your work less generic, more detailed, and well, it's going to make you stand out. So an example that I'm going to use for a subsidy is going to be a $50 billion subsidy between 1997 to 2012 to the domestic automotive industry. So yeah, research on some subsidies that the Australian government gave recently if you want to, So after defining a subsidy and giving an example, let's start on our explanation. So how will a subsidy affect domestic production? This one's pretty obvious, but a subsidy is going to increase domestic production. And we kind of already said it right here when we're defining a subsidy. We'll get into more detail. The subsidy will increase domestic production by the cost of inputs. Now we're going to get into more detail, okay? Because just by lowering the domestic producers' cost of inputs, like there's still not much incentive for them to increase their production, right? If they're not making any more profit. So this is where we include the profit bit. So a subsidy lowers the cost of inputs for domestic producers. So they're going to make more profit. And if they make more profit, they're going to have a greater incentive to increase their production. that's going to increase domestic production. So you can see we're not skipping a step at all. Then when you're talking about profit, make sure to refer back to the model. So we could obviously talk about the increase in producer surplus. Then also for domestic production increasing, you could also say how domestic production will increase from Q1 to Q2. Right, so the sentence would be something like this. So for domestic production, I would be like, a subsidy would decrease the cost of inputs for domestic producers, meaning they will earn more profit. If they earn more profit, they're going to increase their production. That's going to increase domestic production. So you could stop here and you'd get full marks for that bit. But if you wanted to add more detail, you could also add extra stuff, right? The domestic production here, if firms are increasing their production, they're going to demand more labor. If they demand more labor, you could talk about the unemployment rate falling. Unemployment rate falls, you could also talk about disposable incomes increasing. And you can keep going on and on. Increasing disposable income, increasing the standard of living. Talk about demand pull inflation, because people are going to demand more goods and services. So this year, extra stuff. You're not going to get a mark for it specifically, but it's going to add so much more detail to your work, right? Alright, so that being said, that should be pretty good for domestic production. So let's go into import. Alright, so a subsidy is going to lower the amount of imports. Why? Well, because there's more domestic goods, okay? So we could just link this back to our first paragraph about domestic production. So after we finish our domestic production paragraph, we could be like, since there's more domestic goods being produced, the demand for imports will decrease. Therefore, imports will decrease from Q1, Q2, Q2, Q3. So yeah, you could say it like that. So you're referring back to the model. Now, after you're done with that, you could also add extra stuff, but you don't need to, okay? You could also talk about how the decrease in imports would affect the exchange rate, because there's going to be a lower supply of AUD. That's going to appreciate the Australian dollar. You could also keep going. You could add international competitiveness. You could also add, or decrease in imports would increase net exports. Aggregate demand. You could talk about real GDP. You could keep going on and on, but I think for imports, you should just keep it simple and talk about a decrease in import and then refer back to the model. This stuff again is extra stuff. I don't think it's not necessary for imports. Like, although it does add more detail, it's not like that good, okay? Like, this amount of detail is just like, it's overkill. It's not that good. But compared to this is much better, okay? So I would say just stick to this. If you want, you could also add the extra stuff. But I'm just showing you guys the things you could talk about. So after talking about imports, if you just talk about two of these right here, the decrease in imports and referring it back to the model, you would get full marks for the import bit. So let's go on to the market efficiency. The market efficiency, you're going to have to include more detail compared to imports. Roughly the same as the domestic production bit right here. So let's do market efficiency. The market efficiency will decrease. There's a subsidy. Now, why does this happen? Because dead weight loss is created. Now, depending on how you draw your subsidy graph, you might explain it differently. Well, for the textbook, it would be ABC. Like, you know, when you do the subsidy graph and then it's like a triangle, then it'll be A, B, and C. So that's the dead weight loss. Or you could just be like, therefore, dead weight loss is created, aka the triangle, something like that. But the best way I'd say is the ABC triangle. So after talking about dead weight loss, well, okay, dead weight loss is created, but how is it created? Or like, why is it created? Because the cost of the subsidy is more than or greater than the increase in producer surplus, right? And then you could say, which leads to a inefficient allocation of taxpayer dollars, taxpayer funds, which could have been used elsewhere in a more productive industry. You could give an example, aka the mining industry. So just by talking about this, you get full marks. The extra things that you could also talk about total surplus. And another thing that I like to include, and I reckon you guys should also include, is also include how inefficient producers, call it inefficient prod. Talk about how inefficient producers are still able to produce, right? So that's going to lead to an inefficient allocation of resources such as labor. That's another thing you should add. But extra stuff you could add, like that's not related to all of this this question. You could also talk about consumer surplus. Obviously it stays unchanged. So just be like, also consumer surplus stays unchanged as consumers are still paying the same price and receiving the same quantity. Easy as that. You can talk about consumer surplus, total surplus. But in my sample answer, I'll only be talking about the stuff in green. So I'll be talking about all of this here. Then I'll be talking about imports and just referring back to the model. Then for market efficiency, I'll just be talking about this. Yeah, this is what I'll be talking about. But you can see there's a bunch of other stuff you could add. I would probably add total surplus as well because it's more relevant to the model. Yeah, so I'll show you guys the sample answer right now. So this is a sample answer. You can see I defined what a subsidy is and then gave an example of when the government used the subsidy. And then this is my explanation. Now we have enough detail, but another thing that we did is that we included the model within our explanation. You can see here the increase in producer profit, PD to PW, the increase in domestic production, Q1 to Q3, the increase in producer surplus, PD, PW, AC, and then also talk about imports and dead weight loss. So our explanation's good. Now let's look at the model. So here you can see how there's no arrow for the price. And the reason why there's no arrow going from PW to PD is that would indicate that domestic producers are charging a higher price, even though they're not. This difference here from PW to PD just basically shows the amount of money that the government is giving to these domestic producers. So PD is how much the domestic producers are earning after the subsidy. PW is how much they were earning before the subsidy. You can see I have ABC, imports right here, import 1, import 2. And if you wanted to, instead of saying Q1, Q2, you could obviously just say import 1 to import 2, for example. And I also got really specific here, so I added domestic supply and domestic demand and foreign supply. Now, you're not going to lose marks if you don't do that, but the reason why I made it more specific is because this is international trade happening. And well, we're just flexing on the markets, right? Now let's move on to the next question. Question 26A1. Identify how much the AUD depreciated from its peak in January 2018 to its lowest point in 2020. So its peak in January 2018 would be 0.81, or you could say 0.82. And its lowest point in 2020, you would say 0.56. So we're just calculating the depreciation. So that's 0.81, take away 0.56, and that's going to give us a depreciation of 25 cents. Now part 2, calculate the approximate percentage change in the exchange rate from its lowest level in 2020 to its peak in 2021. So its lowest level in 2020, that's just 0.56, and its peak in 2021, you would say is 0.80. So we're calculating the percentage change from 0.56 to 0.80. Now the formula for the percentage change is the new year, so that's 0.80. Take away the previous year, so that's 0.56. Divided by the previous year, so that's 0.56, times 100. So once we substitute these numbers in, so 0.80 take away 0.56 divided by 0.56 times 100, that's going to give us 42.8%. Round that up, and that gives us part B. Outline 2 possible causes of the depreciation of the AUD in 2021. So you can talk about any factor that you want. However, it's best to talk about real world events that did happen and did cause the Australian dollar to depreciate in 2021. That way you can include stats and examples. So let's go through the potential factors of a depreciation of the Australian dollar. So we have a decrease in relative interest rates, decrease in the terms of trade, decrease in global economic growth, decrease in commodity prices, and an increase in domestic inflation. Now, I'm going to be talking about the decrease in relative interest rates and the decrease in the terms of trade. So let's do the planning for our decrease in relative interest rates. We would have to link it back to the exchange rate eventually. So let's just write this here. We have to link this back to the exchange rate. But before we do that, let's see if we can include like a stat or a real world example. So in 2021, by then the RBA had lowered their cash rate. They had lowered the cash rate to 0.1%. So that's going to decrease Australia's relative interest rates. Now, if Australia's relative interest rates fall, well, what's going to happen? Well, that means domestic and foreign investors are going to earn a lower return on investment, as they can invest abroad or in different countries and gain a higher return on their investment. But as their return on investment falls, well, foreign investors are going to invest less into Australia. So that's going to decrease foreign investment, which would mean a decrease in the demand for AUD. And then that would cause a depreciation in the Australian dollar. Now you could also talk about domestic investors. Well, as they make a lower return on investment, they're going to invest more abroad to, gain a higher return on investment. So that's going to mean a higher supply of Australian dollars. Why is there an increased supply of Australian dollars? Well, as domestic investors start investing more abroad, they're going to have to exchange more Australian dollars for the foreign currency to invest in the foreign country. The higher supply is also going to cause a decrease in the Australian dollar. So this is our planning for our relative interest rate. So I'll just move this here. Now let's do the planning for our terms of trade. So a decrease in the terms of trade. Now we have to link this back to the exchange rate. Once again, it's going to be a depreciation. So can we include any examples of stats? Yes, if you can, include maybe like the terms of trade decrease from this to this, from like 100 year 1 to 90 in year 2. If you can find stats or examples for it, go for it. But I'm not going to be doing that. So for now, I'll just have a decrease in the terms of trade. Now we have to link this back to exchange rate. Well, a decrease in the terms of trade could mean two things. Either Australia's export price index fell, or Australia's import price index fell. Now it doesn't really matter. You could talk about both, or you could just talk about one. So in this case, I'm going to talk about both, as why not, right? The decrease in the terms of trade means a decrease in Australia's export price index. If Australia's export price index falls, that means foreign countries need less Australian dollars to purchase Australia's exports. So that's going to decrease the demand for the AUD. Now, if the import price index increases, that means domestic consumers or households have to pay a higher price for their imports. So they have to exchange more Australian dollars for foreign currency to purchase those foreign goods. So that's going to increase the supply of the Australian dollar. Now, both of these factors are going to cause the Australian dollar to depreciate. So this is the planning for both of our factors. Now let me show you guys a sample answer. So here in my first cause, I talk about the RBA lowering the cash rate to 0.1%. And then here I link it back to exchange rate and how it caused a depreciation. Same thing for my second cause. Now let's go on to the next question. Part C, using the aggregate demand / aggregate supply model, explain how a depreciation of the AUD is likely to affect consumers and the business sector of the Australian economy for 6 marks. So we know our model is going to be 2 marks, so that leaves us with 4 marks for our explanation. Safe to assume a 50-50 split, so 2 marks to talk about consumers, 2 marks to talk about the business sector. Now, before you start explaining how a depreciation affects consumers and the business sector, I recommend that you define a depreciation. And after you do that, you could also provide an example of when the Australian dollar depreciated. That way you can use this to start explaining how it would affect consumers and the business sector. Now again, these two are optional. You're not going to lose marks if you don't include it, and you're not going to gain marks if you do, but it'll add more detail and it'll show your knowledge. So let's get into the planning for the effect on consumers. So during a depreciation, that would cause the price of Australia's imports to increase. So consumers are now paying a higher price for imports, so they're going to demand less imports. And also because they're paying a higher price and receiving a lower quantity, that would decrease the amount of goods they can consume, so therefore decreasing their standard of living. Now, after you talk about the decrease in imports, you could also talk about how this would increase net exports, which then would increase aggregate demand. So when using the model within our explanation here, so this is really what you have to include for the consumer side. Remember, it's only 2 marks. Now let's get on to the business sector. So the business sector, there's different types of businesses and they will be affected differently, right? So the main 3 businesses that Scarza would want you to talk about are businesses that import inputs, businesses that export their goods, and businesses that compete with imports. So let's do the planning for businesses that import inputs. So if there's a depreciation, we know that's going to increase the price of imports. So therefore, it would increase the cost of inputs for these businesses. Now, as these businesses face a higher cost of inputs, they're going to make less profit, decrease their output, and it would also decrease short-run aggregate supply. So this would shift short-run aggregate supply to the left. Now you could stop here, but also if you want to, with all of these ones, you could also talk about the macroeconomic effects, which we'll do later. Now, businesses that export their goods, so a depreciation in general would benefit businesses that export their goods in the long run. Why? Well, as a depreciation occurs, that's going to make Australia's export prices cheaper. So therefore, Australia's goods are more cheaper relative to foreign goods, and that's going to increase Australia's international competitiveness. So as Australia's international competitiveness increases, these businesses are going to make more sales, make more profit, and eventually in the long run, they will increase their output. So they're benefiting from this. And then for businesses that compete with imports, it's pretty much the same story. They're going to have higher sales and a higher level of profit, and eventually they'll increase their output in the long run. Now, why do they have higher levels of sales? Well, it's because consumers are now demanding less imports. So that means they are demanding more domestic goods. So obviously that's going to benefit them and increase their sales and profits. Now, after you talk about all of this, you can then talk about the macroeconomic effects. So you could talk about real GDP. And then you could also talk about economic growth, which is pretty much the same thing. You could also talk about the unemployment rate and inflation, which is just the price level pretty much. Now, I'll be talking about real GDP, economic growth, and inflation as they are part of the model. And if I talked about unemployment, well, I wouldn't have enough room. So let's do the planning for the model. So we have a ADAS model. Now let's figure out what happens to our curves. So starting off at aggregate demand, we know aggregate demand is going to increase. As consumers purchase less imports, that's going to increase net exports, increasing aggregate demand. Also, as businesses export more of their goods in the long run, that's going to increase net exports. Either way, aggregate demand will increase due to the increase in net exports. Another reason why aggregate demand would increase is due to higher levels of consumption. So as consumers demand less imports, that means they're now purchasing more domestic goods and consuming more domestic goods. So therefore, that would increase consumption. Now, as the level of consumption increases, that would also increase demand pull inflation, which would increase the price level. Now, the price level would also be increased due to the higher cost of inputs, as stated before. So the increased cost of inputs, that's going to cause cost push inflation. So the price level increases both due to the demand pull inflation and higher levels of cost push inflation. So now that we have the price level out of the way, we also know short run aggregate supply will decrease due to the increased cost of inputs. Now, long run aggregate supply is not affected at all, so we don't even have to include that in our explanation. Or if you have space, go for it. Now, for real GDP, this one's weird, right? An increase in aggregate demand would increase real GDP, but a decrease in short run aggregate supply would decrease real GDP. So what should we do? Well, generally, in SCARSA marking keys, you would want a depreciation to increase real GDP. So we would do an increase in real GDP. And often, the increase in aggregate demand is greater than the decrease in short-run aggregate supply. Anyway, so that would increase real GDP. Now let me show you guys the sample answer. So this is the sample answer. You can see I defined a depreciation. However, I didn't include an example of when the Australian dollar depreciated. If you have enough time or space, I recommend that you do it. Now here you can see I used a model within my explanation. And then I also included this sentence about stagflation. Now in a nutshell, stagflation is when the level of short-run aggregate supply decreases, which causes the price level to increase. So this is my paragraph for the business sector. This is my paragraph for consumers. And my last paragraph, I include how real GDP will increase. Now let's look at the model. So looking at the model, you can see how the increase in aggregate demand is greater than the decrease in short-run aggregate supply. So that's going to increase real GDP from Y1 to Y2. Now, I started my economy off at equilibrium. However, I would recommend that you start your economy in a contractionary gap. That way, you don't have your economy in an expansionary gap after the depreciation happens. And it's more realistic. Now, looking at the price level, you can see the price increases from PL1 to PL2, cost push and demand pull inflation. Now, let me zoom out so you guys can see the whole answer. So this is the whole sample answer. Now let's move on to the next question. So on to question 27. A1, identify the phase of the business cycle the economy experienced between 2020 and 2022. So we just have to look at the economic indicators for 2020 and 2022. So looking at the change in real GDP, it increases from 1.2% to 1.8%. So to me, that would indicate that the economy is in an expansionary phase. Looking at the consumer price index, it decreases from 3% to 1.9%. So typically, that would indicate a contractionary phase. The unemployment rate decreases from 7.5% to 5.1%. And this would indicate a expansionary phase. So it's 2 against 1, so it's safe to assume that the economy in a expansionary phase. Now, before we move on, let's figure out why a decrease in the consumer price index would still be true during a expansionary phase. As typically during a expansionary phase, you should see consumer price index increasing as people demand more goods and services. So a plausible reason could be due to the increase in labor productivity. So this hypothetical economy could be experiencing a higher level of labor productivity, which would increase real GDP, and it would also decrease the unemployment rate. Now, how does this decrease the consumer price index? Well, if producers are more efficient and productive in producing their good, that means there's going to be a higher supply of goods and services. If there's more supply, you're going to see the price falling, which is the same thing as the consumer price index. Also, as the level of labor productivity increases, this would decrease the cost per unit of output, meaning producers are still using the same amount of labor. However, they're still producing more goods than before. That's going to decrease their cost per unit of output. So with a higher supply and a lower cost per unit of output, that's going to cause a decrease in the consumer price index. Now let's go on to part 2. Calculate the current account balance for 2022. So to calculate the current account balance, that's just the balance of goods and services plus the net income balance. So for 2022, it would just be 120 billion plus negative 30 billion, and that would give us a current account surplus of $90 billion. Now let's go on to part B. So part B described 2 possible causes of the phase of the business cycle identified in part A1 above. So here we're just explaining how can the economy go into a expansionary phase? There's a few things you could talk about, right? Talk about maybe fiscal policy, talk about monetary policy, you could talk about global economic growth, right? So you could talk about these factors. Now, I'm going to be talking about monetary policy and global economic growth. And the reason is because, well, I can use these indicators within my answer, right? So when I'm referring to monetary policy, I could refer to the cash rate. So I could be like, because in this hypothetical economy, the central bank decreased their cash rate from 0.5% to 0.2%, and then I'll explain, and then I'll state how this leads to an expansionary phase. And then for my global economic growth, I could refer it back to the balance on goods and services, right? So they're going to demand more exports. We're going to make more profit, which would turn the economy into a expansionary phase. So let's just do the planning real quick. So for the first one, let's just do the monetary policy one. So I'm just going to refer to it as the central bank, as this is a hypothetical economy. Doesn't really matter if you use the RBA. Then probably not going to, duck off marks, but yeah. So monetary policy, and then I'm just going to say, for example, 2020, the central bank decreased their cash rate from 0.5% to 0.25% in 2022. And then I'll explain. You could explain using the transmission mechanism, but since this is just a describe, you would just probably just talk about one channel. So the decreased cost of borrowing. So, if there's a decrease in the cost of borrowing, people are going to take out more loans, and then they're going to increase investment, increase consumption. These are going to increase aggregate demand. Then that would also increase real GDP. And then you could go on to talk about how this would obviously turn the economy into an expansionary phase. If you wanted to, you could also talk about how the decrease in the cost of borrowing or the decrease in the cash rate would also cause an increase in net exports. Because if you decrease the cash rate, then this hypothetical economy's relative interest rates are going to fall. The people are going to demand, less of their currency. So that's going to decrease or depreciate the value of this currency. So then making their exports more competitive. You get the point. So these are the things you can talk about for the monetary policy one. For my sample answer, I didn't talk about net exports, as by then there would be too much. Now let's do the planning for our last one, which is the increase in global economic growth. Let me just split this here. So an increase in global economic growth, this is where I refer back to the balance of goods and services. So I'll just say the balance of goods and services increased from 60 bill to 90 to 120 bill. I'm talking about global economic growth. As these countries experience higher levels of economic growth, they're going to demand more of this hypothetical economy's exports. That's going to increase their balance of goods and services. And then here I refer back to the indicators. Then, if they have a higher balance of goods and services, that means they're making more profit. That's going to increase real GDP. Then you can talk about expansionary. So let me show you guys a sample answer. So here would be a sample answer. So I talked about this would be the monetary policy. Talked about a decrease in the cash rate. I refer back to the indicators that were given. And then here I link it to how it would cause the economy into a expansionary phase. And then I do the same thing for the increase in global economic growth. Now let's go on to the next question. Part C, assume that the economic indicators for 2022 shown in the table on page 14 applied to the Australian economy. Using the aggregate expenditure model, demonstrate the likely stance the Reserve Bank of Australia would adopt in order to influence economic activity, and explain the impact of this stance for 6 marks. Now we know our model is going to be 2 marks, so that gives us 4 marks for our explanation. Now we have to figure out the stance that the RBA would take, so that would be 1 mark, and that gives us 3 marks to explain the impact of the stance on economic activity. So let's figure out what the RBA stance for 2022 would be. So looking at the change in real GDP in 2022, it's 1.8%, which is below the RBA's target of 2 to 3%. The consumer price index is at 1.9%, which is also below the RBA's target of 2 to 3%. And the unemployment rate is at 5.1%, which is above the RBA's goal of 4.5%. So it's likely the RBA would implement a expansionary monetary stance. So let's do the planning for our question. So we have the aggregate expenditure model, meaning we have to talk about the multiplier effect. And also because the Reserve Bank of Australia is changing their cash rate to influence the level of economic activity, you also have to mention the transmission mechanism. Now, before you guys do that, I recommend that you guys define monetary policy. So monetary policy refers to when the RBA changes the cash rate to influence the level of economic activity to reach their macroeconomic objectives or their goals. So you could include their goals in the definition of monetary policy, or you could include it in a separate sentence, and that's what I'm going to be doing. After you do that, you talk about how this is done via the transmission mechanism, and if you want to, you can include the 4 channels. So after doing that, let's go through what stance the RBA would use. So we know the RBA is going to use a expansionary monetary stance. Make sure to include the word monetary. So after the RBA uses their expansionary monetary stance, that's going to decrease the cash rate, as during that stance they're decreasing the cash rate, right? But then that's going to affect the 4 channels in the transmission mechanism, which then affects the level of economic activity. Now, what are the 4 channels? So we have the cost of borrowing channel, the cash flow channel, the wealth and assets channel, and the exchange rate channel. Now, a decrease in the cash rate is going to decrease the cost of borrowing, as people have to pay less interest on their loans. And if you wanted to, you could also talk about the decrease in savings, as people would be earning less interest in their savings account. Now, both of these factors are going to make spending more attractive. So that's going to increase consumption and investment. Also, for the cash flow channel, with a decrease in the cash rate, this would increase the cash flow for people with variable loans, for example, mortgage homeowners, as they have to pay less interest on their repayment. Therefore, they can use more of their money to purchase goods and services, hence increasing consumption. And for the wealth and assets channel, well, the decrease in the cash rate would allow more people to have access to cheap money, so they can use this money to purchase assets such as homes or stocks. As these people demand more assets, the price of these assets will increase. So the people who already own these assets are going to feel more financially stable. So they're going to increase their consumption and investment. And for the exchange rate channel, well, the decrease in the cash rate would also depreciate the Australian dollar. So that's going to make Australia's goods more competitive. So we would sell more exports, hence increasing net exports. Now, for the economic activity, this is what you would have to talk about. Now really, you just have to talk about the aggregate expenditure increasing, real GDP increasing. You could talk about the inflation. You could also talk about the unemployment rate. But the one thing you have to talk about is the multiplier effect. So obviously, we'll refer aggregate expenditure back to the model. So AE1 to AE2. Same thing for real GDP. Now let's do the planning for our model. So for our model, it's pretty simple. We're going to see aggregate expenditure increasing, and then we're also going to see real GDP increasing. Now, remember when you do the model, make sure that the increase in real GDP is greater than the increase in aggregate expenditure. That way you can illustrate the multiplier effect. Now let me show you guys the sample answer. You can see how after I mentioned the consumption and investment spending increasing, I don't talk about aggregate expenditure straight away. And the reason is because if I do that for each of my channels, well, that's going to be repetitive and it's also going to waste my time. So I mentioned it here where I tied it all together. I talked about net exports, consumption and investment, which all increase aggregate expenditure. Down here, you can also see how I mentioned the multiplier effect. And then let's look at our model. So looking at our model, the increase in real GDP is greater than the increase in aggregate expenditure. So that shows the multiplier effect. Now, let's move on towards the next question.